Why conservation carbon credits do not work, and how conservation finance should work. Conserving natural forests is essential to maintain a natural resource balance for the planet. There were somewhere in the region of 6 trillion trees before humans, it has been estimated. There is now half that amount and reducing fast. Forests are the lungs of the planet, producing oxygen while absorbing atmospheric carbon. Forests are a natural entry point for water into the ground through nature's organic filters. Forests are the source of so much biodiversity, from where pollinators, predators, pharmaceuticals, and foods have originated. Oceans, mangrove forests, and many other natural areas are equally as important to be conserved. This conservation methodology works for all of them. Carbon markets attempt to raise capital from carbon flows and carbon stocks of natural forests. Carbon flow is carbon added to the forest from new growth. Carbon stocks are the amount of carbon currently in the forest being protected. Unfortunately, the carbon amounts and values simply do not accumulate enough commerce to protect the forests. As a result, the credibility of the conservation is regularly called into question as projects are run by companies with commercial agendas with insufficient funding. Conserving a forest is the value proposition. The protection of the forest or ocean is the outcome. The conservation operator for the funding should be the government as the most credible agency. They will participate because they benefit from reduced costs. After all, the conservation revenues will pay, not the national budget and taxpayers. The conservation project will now be credible because the partner to the funding is a motivated government with final authority over the conservation. The funding value is generated from the actual conservation statements made by the government, confirming that the area has been conserved. The value proposition is qualified by the measured area being conserved and the ecosystem service outcomes such as the carbon credits, the social benefits, water credits, biodiversity credits, and even erosion or soil credits. There is social investment funding included in the conservation budgets. The funding can be structured as forever finance for the conservation and social activities. How do you value conservation? Ultimately, the market will price the conservation area if it is structured properly. This must include the reason why the market would invest into the conservation. Consumers are many times more likely to buy a product if it will directly conserve a forest or an ocean. Corporations will provide the consumer opportunity if it builds value for the shareholders and company. By aligning their brand and products with government conservation that confirms their good intentions, and the accounting efficiency from this conservation finance, the value proposition framework is built for every company and brand to participate and profit. This is a perfect alignment of shareholders and consumers to sustainable outcomes. Conversely, just buying carbon credits is an accounting cost that loses much of its credibility and value as it is separated from the actual projects and misses much of the brand statement value. Structuring the conservation rights as a fungible, tradable asset aligns consumer, corporation, and conservation, without change of ownership or risk to the land and forests. Conservation financial instruments such as a coin, token, or NFT will allow companies to combine costs, CSR, carbon, SDG, ESG, brand, and marketing, into the purchase of conservation assets. This accumulates considerable accounting efficiency and value, arguably some 200%, that becomes a motivating factor for engagement for companies. Every company can now be involved with government projects that make a difference. Where there were costs, there are now assets, potential revenues, and capital gains. Essentially, companies buying these conservation assets would be adding value to their company balance sheets with potential future growth. Government conservation would build value into their economy, and the companies in that economy, by developing their projects in this way. The government would further benefit by reduced costs and investment into conservation and social development with reduced cost burden to their budgets, an excellent example of their economic and policy competence. The cost establishes the pricing for the conservation units initially. Their future value will be reflected in future market demand for these finite conservation assets that produce ecosystem service value and ESG metrics in support of their value. Imagine that these conservation assets hold the future conservation rights for the permanent conservation of the Amazon forever. This is possible with some simple understanding of conservation financing, accounting, and equity value protection and development without losing national or indigenous land ownership or conservation rights. Best of all, everyone benefits from the conservation which aligns everyone with the outcome so desperately needed. Would a consumer buy a branded coffee or a shoe that saved forests or oceans over a brand that did not? In many cases, this is a perfect opportunity for the consumer to make a difference simply by making purchasing decisions that better protect the planet. Consumer choices will build corporate participation in conservation in huge volumes. What chairman or CEO would not want to report on their ESG efforts by saving the Amazon forests? Development partners are welcome to bring this to the market. For more information on conservation finance, please contact the Efficiency Professor. Thanks for watching another Efficiency Professor Media presentation.